thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%.
So far.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled.
Did you know Appliance Track has a negotiated special discounted delivery pricing for your area? We have a lot of customers from your area who buys from our Fruitland Park store. But delivery company wants to charge a fortune to deliver there. So
the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning, and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
More wait and seeing. I love the wait and see.
Nick Timmerosa, The Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that when there's a foggy situation, we slow down to mean that there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually,
is
maybe just a
Monday's
touch
high.
more gradually than we thought.
860.
In terms of inflation,
So good liquidity up there.
we are
Maybe
it's
wait for
come in a
retest,
touch
though.
lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that
Get huge savings on your new replacement windows during Renewal by Anderson's 31-day sale. Call this number now and schedule your
even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussion of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
No, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
Like,
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break-evens, and they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting
Kinda
you to get
screwing
back to
around, if I'm
2%,
being
and
honest,
Americans
guys.
overwhelmingly
So I'm
are
only
citing
just keeping
high
it to one.
prices,
There's too
inflation
much
as their number one
volatility. It's
concern.
news.
Can you explain to them why you're prioritizing
Just
the
kinda having
labor
some fun.
market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But, it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation.
Hey, what's up? Good news. Yeah, it is, sir.
We're well aware
Yeah,
that this
50K.
is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot.
It's up 182
and we do
at the
think
moment,
of those
but we're down
as
36
likely
on the day.
in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And So there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low. If there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious.
I still think it wants to hit 860.
Longer term, though, the question is, what are we going to see here?
Risk
we don't know, but
is destroyed now, right?
It may be that
trying to get 10 points, but your risk is 50 points
really
down.
Significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what? On
the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine. Thank you.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So As how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. What we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record. Yeah,
so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic.
We're Root Insurance, and our drivers gave us a 4.7-star rating. That's almost perfect, and we're proud of it.
When a family member suffers an accident, it affects the entire family. If you've been in an accident or suffered from medical...
guys.
Estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? So that's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think, again, all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I think I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having, social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Why? Bring me the instructions, I can look at it.
Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields, to be more precise, have peaked, while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage?
Mom, come on. My game said I want a prize, but I need to put in your credit card to claim it. Just for ID, not payment or anything. Everyone else.
Don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
I think the batteries are already dead, bud. Yeah, I think the batteries are dead. I can move it for just like 10 seconds and then it dies. What? Yeah. See, it's working, but then if you put it on the ground, it dies really fast.
What about mine?
I only have one of them.
Mine's right here.
Where's your controller? Oh, son of a gun. Is this oh, we're done. We're done. We're done. Powell's done. That was it. Wow. Well, okay. Papa P. So let's see. I mean, again, what I was trying to say is we just broke Monday's high. We just broke our previous week high. There's a lot of reasons for us to go down now, if I'm being honest. Shoot, I'm almost tempted again. It's kind of a premature sell. But we kind of hit everything I think we wanted to hit. I don't know why we'd keep going up at this point. So this is kind of going against everything, keep in mind here, gang. So I don't know if anybody should follow this or not. But this is just a thesis, right? We don't have anything yet saying that we're going to go down, minus the fact that we just took out those, took out some liquidity there. So just kind of presuming. I mean, it wasn't like earth-shattering news or anything like that. Why? I highly doubt it. Trying to fix this stupid stuff at the same time. Let's get that out of here. All right, let's see. We'll give this just a little bit longer because the kids are going crazy in the background. So I got to go help out this situation. Guess the short might have been a little early. We'll hold it. We'll hold it and see. 4, 5, 6, 7. It's a 40-point stop, which stinks a little bit. Let's see. Does she still have some momentum? Does kind of seem like it, doesn't it? Hey, Wyatt, maybe get a screwdriver and then we'll get all brand new batteries for it. Because these are all cheapo batteries anyways.
What?
These are all cheap batteries anyways. Why don't you go get a screwdriver?
How do you know the cheap batteries?
They're just off-brand. They're bad brand. So I'd almost open it up, take the batteries out, put in new batteries, and then we can try again. It turns on just for a sec. But yeah, I think it's just too weak. Well, when you take these ones out, just make sure it matches the ones you take out of it. Yep, that's what kind of day it is today. Yipes. Why? You better calm down in there. Come on, let's see some weakness. It just makes sense. Don't embarrass me in front of my friends, NQ. We got people watching. They don't want to watch us lose. I mean, slowing down a lot. It could just be building out so it can keep kind of pushing up a little bit farther, but I don't know. The thesis is from 2 o'clock, 6, 7, 8. We've gone up 250 points in the last hour and a half. So it just kind of makes sense that we have some type of a retest, right? Man, here's the thing I never stinking use, Fibonacci. Let's see what happens. Well, it's not really helpful, is it? I'm doing this the wrong way. Again, I never use it, gang. Maybe you're supposed to bring it down to where the move started. So now that's the 100% of the move. So 50% retracement would be right here. 730s. So if I'm correct, maybe we fall back to the 730s. I guess let's not get too overly greedy. Maybe we'll 769. We'll target a 769. Come on, break it. Break it, break it, break it. We got the EMA curling down a little bit. But we're fighting everything here. We're fighting the trend. We're fighting it all. Let us see. The retest otherwise is something like this. This would be like 760s, and yeah, 769 is what I have for my 38%. We'll see. Ugh. Ugh. Hey, what's up, Sod? How we doing, bud? Yo, yo, yo. It's been a mixed bag, man. This morning, I didn't do great this morning, if I'm being honest. I kind of, man, my timing was just off again. I had the right sentiment, but kind of the wrong timing. I was long. Right away. I was long pre-market. I was long at 9 o'clock, thinking that we'd get that pop sooner than we did, and we didn't. I mean, unfortunately, kind of my theme of today is kind of what we're doing right now as well. Things that make sense, but they're kind of against, you know, reversion plays almost. Like right now, during FOMC, we took out Monday's high, we took out previous week's high. We've had a little curl down afterwards, but my thesis, even though nothing is telling me it, is that we're going to go down. Just purely because we hit those. We hit those, so I'm thinking we're going to go down. So I'm in a short here. It's a little bit early, admittedly. And that was kind of my theme of this morning, too, is right concept, but every single time it was just early. Not patient enough. How about you, bud? How you been? How's today been for you? Lovely. Papa Powell with his purple tie. Papa Powell purple tie power hour. Whew. There you go. You get to have some parenting advice in the background too. Wrong. Come on. Let's see that weakness. SPX. Oops, what's going on with all this? Where is this guy? Oh, because it's up in my 10 or my hour. SPX is looking real strong though. So the reversion play is probably not going to work. Only foreigners kind of indicating a big gap up tomorrow morning. Dang. Yeah, silly of me for trying to go short here. Again, I thought it would just be a quick little reversion play. We lost these, so I was like, yeah, maybe. Maybe, baby. She's getting on him.
By energy. And when energy comes down, everything else comes down. But I've only been
Oh,
here a short
sorry.
while.
Look at that's the wrong
We
one
gave
now.
them a beautiful,
Sorry, Trump. Well, maybe we can leave Trump on. You guys want to listen to Trump while we trade? Last half hour. It'll be interesting to see how MOC goes, right? How 350, how does 350 go on days like this? When we've had a big launch up like this, does 350 shoot it down or does that continue to shoot it up? Nice little bull flag forming. Uh-oh. What a stupid thing. Still trying to get this little guy to work. Got a little battle bot right here. Yeah, why? Stop, this is getting really annoying. 7-year-old just king big dick these days. That's what I'm saying, man. Well, you know, because we homeschool our homeschool our kiddos. And then, like I said, the last 3 years, we've both been, you know, working from home, which is whatever passion projects we kind of go on and stuff like that. So it's a lot of togetherness, which is a beautiful, beautiful, beautiful gift. But then once in a while, it's a beautiful curse as well. So right now, my, the 7-year-old and my wife are kind of butting heads a little bit. Which, again, I shouldn't be trading right now. I should probably kind of go tag in and help her out for her sanity, you know? Yeah, every coin has two sides. Shoot, I would like to make 12 more minutes, kind of see what happens with MOC, but Yeah, I gotta go help him out sooner than later. You calm down. Jetty, you calm down. You calm down over there. You silly stinking pup. Oh, boom, 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 boom. Come on, just have this thing sledge off. Let us be right. Just crazy consolidation here. 861, 843. Jet, stop it, baby. Oh my God, just chaos here today. Hey! Good God. Coming to India, Saad. I'm escaping to India. You have to give me whatever, sanctuary. safe passage. Let's see a giant M to sell off the day. That's an ugly looking screen right there, but boom, 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 boom. How are you guys feeling? You guys feeling bullish into the end, or we feeling bearish into the end? I honestly was hoping for a quick little bearish move, but unfortunately, it did not happen. I guess I can probably bring this stop down just a little to reduce the overall risk. Oh man, sorry, this is nuts. Hey babe, just walk away from him. He just wants to talk. You guys are talking for 3 hours now. You're in circles. Come on in, babe. Yep. Wow. Whoops. All right, Nasdaq. Let's do it. Let's break through this EMA and let's get this stinking party started. Come on. Let's break. Let's break. Let's break. Let's break. Let's break. Let's break. I mean, SPX got this big old imbalance down here. Big old juicy imbalance. It's going to want to touch it. Come on. Come on, Mr. Short. Let's start shorting. Nvidia's looking a lot weaker now. IWM is starting to look a little weak. Qs are starting to look a little weak. Uh-oh, gang. Uh-oh. Let's see. Look at this. NVIDIA, if NVIDIA starts slushing down, be the first to fall, first to break. Come on. Let's move this down here
Anybody
so we
have
don't
anything
accidentally
else to
click
say?
it again.
Anybody?
The other thing is, we want to thank you as well for the openness of your.
A little Trump cameo. I invited him to my stream. He wanted to come on earlier, but I told him I was busy. I said, I don't have time for you, Trump. Ugh. Paint drying type day. Almost back to that blue line of resistance. Which, man, if it breaks, do we add more? You know? This is the 5-minute. Man, we just need 827 to break. Man, everything is just kind of tightening up. Tightening up. It's either going to blast up or it's going to blast down. Unfortunately, I guess probably ups at this point. Yeah, I mean, we're right at the top of. Sorry, it's such an ugly screen right now. Hold on, let me see. I think I got a 15-minute here. Yeah, this is a 15-minute. $878. Do we hit? We didn't hit 878. What was our high? 873. Pretty stinking friggin' close. Yeah, I mean, basically all of the targets to the upside, for the most part, have been taken out. The only one above it might have been like, 893, and then we're looking at 900. Which we didn't get bad news today. But we just got expected news today. So when you just get expected news, what happens? Jetty, why are you freaking out, man? Why are you freaking out, Bugs? What's going on? Oh shoot, only 2 minutes now until MOT. Ugh. Honestly, wasn't trying to hold with that. I was hoping that the move would happen before that, because I don't want to get snagged in a rocket ship up for no reason, which I'd be very surprised by. Look at this blue line of resistance. We haven't been positive on this trade for 25 minutes. Is this how long I've been holding this thing? Dang, guys. Thanks for sticking with me. You guys are champions. Look at this. We made this trade at 320. Bleh. That's a long hold. That's a long trade. Got a minute and a half left. Unfortunately, against my better judgment, I guess I'll take my stop away. Sometimes with MOT, you'll just get like a... And I feel like down is the way. I don't know. It's a tough call. Entertainment purposes only. I mean, I don't think it's going to jump really higher than... I don't know. It might. It could blast up to 880. You know. There you go. We're positive on it. Do we hit gray button now? We're up 50 cents. See that green 50 cents and just 40 seconds. Up $5 on it, guys. $5 on it. Up or down, up or down, up or down. Ooh, I haven't done MOT live. This is going to be a first. It's a first for us, guys. We got 10 seconds. 9, 8, 7, 6. Oh no. What's going to happen? Ah! Oh, wow. That's actually a very, very, very muted reaction. I'm going to put my stop back up. That did not wick at all. So who knows? Maybe it's going to just get weird strength and start going. That was kind of a nothing burger in all honesty. 36 to 50. It was only like a little 20-point blip really quick. Blip. Man, so if it so the exact opposite over the next minute or two, if it stays below, well, not the exact opposite, but if it stays below 860 over the next minute or two, then I have to imagine we're going down. Volume has dwindled out to nothing. See, this is just what you wouldn't want. If green candles start stacking quickly, like shorts, if shorts start getting squeezed out, you'll see green candles just beep, 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 beep. But at the moment, we're still looking kind of good. We just need this thing to break already. There we go. Come on. Starting to break. Up 10 points on it right now. I mean, we held it for 30 minutes, so I think I'm going to try to hold for like 769. Try to hold for something that makes a little bit more sense, you know? At the very least, 800. That could be a potential. Or 84. Up 10 points on it finally. Almost considering adding to this. Just live life real dangerous.
Order filled.
All right, the add, we are going to try to target the 800s now instead. So that would be about 15 points on the add. And then hopefully we'll allow the other one to run a little bit here. I guess stops are just right at the top of that candle. Which again, hopefully not too many people are shorting right now. If too many people start shorting, that's going to push the price up. Going to shoot ourselves in the foot. There we go. Come on. Come on, come on, come on, come on, come on, come on, come on. Let's get a trade. Come on, come on. Oh shoot, what time is it? We got a minute before. Got 1 full minute before our 3:55 volume. Finally, oh nope. We were green on our ad for a half a second. We got 40 seconds left. $15 seconds, which I guess same thing as last time. Let me move my stops up just in case, but I highly doubt we're gonna have a, how many stops do I have? I highly doubt we're gonna have a crazy reaction at 3:55 because we didn't really have one at 3:50. Yeah, just a tiny little blip. So we'll move these back down again. Come on, sell off now. Sell off, sell off, sell off. That would be so infuriating to hold this for literally 40 minutes and then end up red on it. Frustrating. I kind of feel like it should have gone. Yeah, it should have gone already. We might just be stalled out for the rest of the day. Come on. 10 seconds left. Hopefully this new candle helps us out. Come on. Come on, come on, come on, come on, come on. Come on, come on, come on. Push it down, push it down, push it down.
Stop filled.
Man, that was frustrating. 40 minutes to get 15 points.
Dad, do you know where Mom is?
No, I think she's just taking a little breather, baby.
But where is she?
I don't know. Is she outside? Well, we just kind of fooled around with this one for FOMC. We were down $200 on it. Now we're up $13 on it. So volatility got us a little bit, admittedly. And stopped out for a $7.10 gain. Woo! Give the people what they want. Listen, guys, are you not entertained? We did shit today. You guys showed up. We made $7. I mean, what else is needed, right? You guys got your $7. It's $3.58. $7.10. Actually, let's see what the breakdown is. Whew, 28. I mean, 72%. You know, that wasn't terrible, but again, it was just FOMC. Now we were just using like 1 or 2 micros at a time. But yeah. Yeah, look at all that. We just started going. Oh my God, I can't friggin' talk. Get that beer money. Shit. Get that pack of Sour Patch Kids. You're good to go. Yeah, look at this. Beginning at FOMC. Not the right idea. After he stopped talking, not bad, you know? Oh, son of a bitch. There's our 800. There's the 800 we were waiting for this whole time. Sometimes you just gotta put the trade on and walk away. That's all right. We got our $7. That's all that we need. That's all we need, chat. All right, gang. As always, I appreciate the heck out of you. I gotta go wrestle up this kid, wrestle up the wife. I don't even know. It's about to be like WWE in this house or something like that. But love you guys to death. We'll see you bright and early, 9:25 tomorrow morning. We'll keep rocking and rolling. Keep that journey continuing. I hope everybody has a great weekend. Great end of the day. Great end of the day. We've done 2 streams today. We talked for like 5 hours. Brain is melted. Now we think that it's the weekend. All right, gang.